Earlier this year, the free-floating silver in London metal available for me delivery was about 305 million ounces. And now, as you said, down to about 125. And the drop reflects several important issues. Number one, India's massive import surge during the Diwali season, solar and industrial drawdowns, especially in Asia, and investors moving to physical allocation during the geopolitical and monetary uncertainty. So the inventory has fallen. It was shipped, as you know, from the LBMA into the COMEX, and there was a condition that required that, to fly or boat silver from London to COMEX. Now that's reversed.
My assessment of the momentum of that spread and the spread itself says, no, we're ready for the breakout. It's about to happen. And I think when that happens, that's when you see silver go berserk and catch up for the error of the past 50 years. My suspicion, where do I think silver might be in 6 months? Well over 100, maybe 200.
Silver's story right now reflects both systemic stress and market resilience. The free-floating supply in London has collapsed from over 300 million ounces earlier this year to barely 125 million, a stunning contraction driven by India's unprecedented import surge, industrial drawdowns across Asia, and a flood of investors moving into physical silver. This drain on liquidity forced metal shipments from the LBMA to the COMEX, and now, for the first time in years, that flow has reversed. Arbitrage opportunities are rebalancing, spreads have normalized, and panic premiums have calmed, a clear sign that the system is resetting, not collapsing. Yet beneath the surface, the world is still dangerously short of physical supplies. MichaelOliver and DavidMorgan, two of the most respected analysts in precious metals, emphasize that this calm is deceptive. The paper-to-physical imbalance in silver remains the largest of any commodity market. 7 months' worth of contracts trade against a fraction of real metal, while regulators continue to look the other way. These conditions create both extreme volatility and extraordinary opportunity. Once silver's next breakout begins, it could move violently higher as derivatives unwind and physical shortages collide with demand. The dual nature of silver, part monetary, part industrial, makes it uniquely sensitive to every tremor in global finance. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
No one actually knows the exact amount required by the LBMA to clear the market. And there's lots of moving parts, off-market trades, unreported swaps, and opaque central bank leases. So all that plays into this, possibly. So the key signs, first of all, spreads have normalized. So the market's speaking volumes to us. All I have to do is, look. We don't have to comment on it. We just need to see reality. So the spreads have normalized. The London-New York arbitrage premium has narrowed sharply from a couple bucks. Last I checked, it was like 7 cents. That's a big differential, Daniela, which means the market is calming substantially.
Okay.
Lease rates have fallen from panic levels earlier back to something closer to normal. And the market has sold off heavily, which is another key sign. Yes, I'll be the first to admit that the silver market is a derivatives market. But behind the derivatives market, there's these 1,000-ounce blocks of silver. They all weigh something different. Very few weigh exactly 1,000 troy ounces. There are usually rough pours somewhere around that. The exact amount of weight is stamped into those bars along with the serial number. So I digress to come back. So the worst of the squeeze appears to be behind us, at least temporarily. Earlier this year, the free-floating silver in London metal available for me delivery was about 305 million ounces. And now, as you said, down to about 125. And the drop reflects several important issues. Number one, India's massive import surge during the Diwali season, solar and industrial drawdowns, especially in Asia, and investors moving to physical allocation during the geopolitical and monetary uncertainty. So the inventory has fallen. It was shipped, as you know, from the LBMA into the COMEX, and there was a condition that required that, to fly or boat silver from London to COMEX. Now that's reversed. And the 29 million ounces that you quoted is accurate. and it's been shipped across the Atlantic. But here's the key.
Yeah.
That flow represents the market self-correcting, not a collapse. Arbitrage opportunities triggered by the price spread do exactly what they're supposed to do, and that's move metal from where it is not needed to where it is needed the most. Once that silver lands in London, the spread collapses, and that's precisely what we're seeing right here and right now. Now, the estimates of another 100 million or so to normalize the market could be overstated. Why? London doesn't need to rebuild inventories to that level. It just needs enough liquidity to settle the trades without the premiums exploding. ETFs holdings, central bank leases, and industrial flows constantly recycle metal back and forth into the system. I saw three scenarios. One is 30 million, one is probably 60, 70, and the last one is the 150. And I went through each of those. So a more conservative estimate might be 40 to 50 to 60 million ounces additional to fully stabilize. The big picture is this. The global silver market runs on razor-thin inventories, roughly 3 months of industrial demand or so. Besides the COMEX, Ashanti, which is one of the providers to the COMEX warehouses, has been shipping metal into London. I do not know how much. I couldn't get that data. So there are other sources than the COMEX. So people need to know that. So this underscores what I've said for years. Silver is both a monetary and an industrial metal, and a dual role makes it uniquely sensitive to physical shortages and financial speculation at the same time. And so, yes, the London market is tightened substantially. The spreads are tight, but rates are down. The panic has subsided, at least for now. The underlying issue, a world running short of metal, a system built on paper claims, does remain. It's correcting. So what is the next wave of demand and what stress will return? I'll look in the eye, Daniela. I don't think this is over, but I think there may be a lesson learned here. And will it surface again or not? I wouldn't say anyone knows for certainty, but based on what I've looked at and know, it looks like it could occur again. Would it occur again to this level? My gut feeling is no. I think that there's enough of a shock to the system that those that are behind the scenes, we might say, probably be a little bit more conservative. And if I was short this market and it's getting near the 50-day moving average and I'm able to cover that short, I would probably be letting out a sigh of relief right now. The silver market is the biggest market as far as discrepancy between the amount of paper that's thrown at the market and the amount of physical that exists. No other market in the commodities like cotton or cocoa or soybeans or whatever has that kind of a spread where you've got like 7 months worth of paper to clear the market. But silver's, I should say always, but for a very long time been like that, which means, in my view, there's just way too much paper relative to the actual physical commodity. And reportedly, the exchange is supposed to kind of look at that stuff, but they seem to turn a blind eye to it. I suspect that they've always done it, they meaning the bullion banks primarily, and because of the idea that, well, nothing's happened yet, why not? And then, of course, if you drill down, you got a legal expert at commodity law and put them on the stand, they probably have a very convoluted rationale between spreads, contango, interest rates, and all the things they claim to be using. And some of it's valid. I mean, I don't want to invalidate what their argument would be, but it would be really difficult for the jury or the judge even to come to a conclusion based on the price of money, what the 10-year note is, and what the spread is between the May and the December contract. And we actually have the silver here. Well, maybe they have it in the warehouse, but it's also in the SLV as a medallion or vice versa, so it's counted twice. And on it goes. I don't want to make this convoluted myself, but there is a lot to it. And believe me, when you get into these legal angles on anything financial, it can be an extreme word game that's very, very difficult to unwind. Markets need to consolidate. When they need to digest the congestion, this market really kind of went up. This market, meaning gold and silver, platinum, palladium. These markets really took off. I mean, look at what the average gain is during the 11-year period from 2000 to 2011, that 11-year bull market in gold, every year over year was higher every year. And what the average gain was. These have been extraordinary gains of late. And so it's normal for a market to correct. And it's also normal for it to overshoot. Was that deliberate by, the banksters doing whatever? I don't really know. In a way, I don't really care. I mean, I made my statement many times, but it bears repeating because I'm not sure I've said it on your show. But my take is that the market's long-term trend cannot be manipulated. Just can't. If you can manipulate the market, gold will be at $252 the ounce. It was in 2000 when the last tick to the downside took place. And here we are, 25 years later, we're sitting at, $4,000 the ounce. However, within that trend, yes, you can play games. Yes, you can manage the price. Yes, you can spoof the market. And that's been proven. But at times, it certainly is to the advantage of the shorts to put massive amounts of paper silver onto the market in what we call the off market of the after hours, where the market's extremely thin, where it's a lot easier to move the market. And this has been done again and again and again. It's been put into the legal system and proven.
Silver's technical picture is tightening toward a defining moment. The market has built up extraordinary momentum beneath the surface, the kind that precedes historic breakouts. The gold-silver spread, now hovering near multi-decade lows, is signaling that silver's long-overdue catch-up phase is near. With silver still valued at barely over 1% of gold's price, the setup mirrors the conditions seen before the explosive runs of 1979 and 2011, when silver multiplied in just months. Today's environment combines suppressed valuations, rising physical demand, and a collapsing faith in paper markets, all pointing toward a structural revaluation. The stock market bubble, inflated by years of zero rates and liquidity excess, is nearing exhaustion. As capital flees inflated equities, sound assets like gold and silver stand to absorb that flow. But silver, long overshadowed, carries the asymmetry, the torque, for outsized gains. When the spread breaks, it won't be gradual, it will be violent, fast, and transformative. The signal is flashing green. Let's get back to the interview.
Silver bullion ETFs, silver calls on the bullion ETFs, many of the big miners, mining ETF called SIL. SIL is the silver miners ETF. I've even moved more money out of gold related because I see the silver gold spread as imminent. It's not yet broken out, but my assessment of the momentum of that spread and the spread itself says, no, we're ready for the breakout. It's about to happen. And I think when that happens, that's when you see silver go berserk and catch up for the error of the past 50 years. My suspicion, where do I think silver might be in six months? Well over 100, maybe 200. Stock market, we do not trust here. Let's start with that. The U.S. market is a bubble. It's the biggest bubble it has ever seen in terms of time spent and dimension of move. Especially NASDAQ 100's gone up like 20-fold since 2009. S&P's gone up 10-fold. And they've printed money all the way. You can see zero interest rates for 10 or 15 years. I mean, what the heck? It's free money. Spend it, right? Okay. It went into the stock market. Problem is, when those bubbles break, they go elsewhere. Money doesn't just burn up everywhere. It moves somewhere else, and it always moves into gold and related. Gold has already been advancing for other factors. This would simply be an added factor when the money flow goes from the stock market. Plus, when the stock market breaks, the central bank will go even more berserk in terms of, free money or freer money and more volume of it. Okay. We think we're at a point now in the gold-silver move, particularly silver, I'm going to emphasize that, where what's about to happen is a change in reality, specifically mostly for silver. While gold has gone up in massive waves since it was legalized in 1975, both of the prior bull markets were 8-fold dimension ratio moves. We're only 4-fold from our bear market low in 2015. So everybody's screaming how it's overdone. They're looking at arithmetic charts. They're not looking at logarithmic or ratio charts. We're in a somewhat accelerated price angle of ascent. You can see it on the charts. Silver recently nipped out its highs of the past 50 years. Gold's way above those, layer, breakout, layer, breakout. Silver still caught in its initial layer. Nothing in terms of price momentum. In other words, normally we look at price charts, which everybody wants to see, but below it we do a momentum study of the price action by oscillating those monthly price bars or weekly in their relationship to a given moving average. Either they're above it or below it, therefore you could get an oscillator, okay? And it builds structures, the kind of structures that price chart guys look for. Triple top breakouts, downtrend lines broken, etc. Silver is totally green light in that regard. And we said that back in June when silver for a third time was coming up into the mid-30s. It had been to 35 in October last year and March of this year, dropped down to 27.5, came roaring up again. And we said when it got above 34, watch out, we're going to break out, but it's going to accelerate the angle of ascent. July, August, Sep, Oct. 4 months, we've gone from 35 to 53, and right now we're 47. What a percent move. It's such a momentum knew that. So from a price momentum perspective, there's nothing more to say. It's already positive. The key is silver spread relationship to gold, which has been over the decades, it's very low in relation to multi-decade levels. But it has a structure where you can look at that spread chart, which is divide an ounce of silver to an ounce of gold, express it as a percent. Right now, silver's like 1.2% the price of gold, which is very cheap. If it breaks through that structure that we've defined, and in our reports we give you the exact number, and you close a month above that spread level, it's saying, I'm breaking out of my spread. When you go back and look at that explosion we had in late 79 to 80, where silver had already been going up for years, and suddenly it went berserk. It like quadrupled in 6 months. Or in late 2010, about 6 months before it hit its peak at 50 in April 2011, silver had already been going up for years, and suddenly it went berserk. It doubled in a half in 6 months.
Yeah.
If we do something similar, but the thing that told you back then that it was going to go berserk was the spread. Silver was already full thumbs up, momentum-wise, but what told you that I'm going to lift the lid off in relation to gold? And it was the spread. It had similar structural ceiling on it. It broke through, and at that point, the spread said, I'm going to explode. We're facing that door right now. So that's the technical we're watching, not the price or the momentum of price. If you plot gold in relation to the S&P, since the year 2000, it's been very zigzaggy, but it's been net up dramatically. Okay, gold is beat over that 20-year period, October 2020, October 2000 to this October, 20 years. Gold's gone up like 16-fold. S&P's gone up 4.5-fold. Which is the better place? Yes, there have been some big bear markets in gold, also the stock market, but net on balance, gold's beat. Now, however, since its 2011 peak in gold, its spread versus the S&P also dropped, meaning gold underperformed the S&P during its bear market, 2011, 12, 13, 14, 15. Starting in about 2015, if you plot the spread, divide gold, ounce of gold into S&P price, and plot it month to month, percent, you've been in a basing range where at the top of that range, the gold performance will surge up to a given level and stop, come back up to a similar level, stop, and has built a beautiful trend line going back 11 years with 4 pivot points hitting it. Intra-month this month, of course, we have, 3.5 days left, we've been out above that breakout point. We backed off hard last week, when we had the drop in gold and silver, and I don't know how we're going to end the month. But if gold is 60% of the price of the S&P, it's a major breakout. It's telling you I'm gone. Okay, it's going to break out. Now, when that spread breaks out, the net price of gold it's just the beginning. That spread is telling you at that point in time when you break that spread out, and if it doesn't happen this month, it's going to happen soon, I can tell.
Silver's window of calm may soon close. The charts, momentum signals, and decades-long spread against gold are converging toward a point of acceleration, one that could redefine its value in months, not years. History shows that when this setup appears, silver doesn't move gradually. It surges with force, catching even seasoned investors off guard. The imbalance between paper contracts and physical supply has reached a limit, and when it resolves, the repricing could be swift and dramatic. Markets are cyclical, but sound money always prevails. As inflated assets lose credibility and liquidity seeks real value, silver's dual role as both an industrial and monetary metal will drive it higher. What comes next is not speculation. It's the delayed correction of decades of distortion. The smart money is already positioning before the crowd wakes up. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.